Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with John Bull and Ellie Theochari.
Hello and welcome to The Tax Factor, the UK's top tax podcast, where we break down what's happening in the world of tax and why it matters to you. I'm John Bull.
And I'm Ellie Theochari.
While the spring statement itself may have seemed light on headline-grabbing tax changes, it's only now, as the new financial year gets underway, that the full impact is becoming clear. April has ushered in a series of significant tax shifts that are hitting the pockets of individuals and increasing costs for businesses across the UK.
Rising employer NIC is driving inflation, electric vehicles are no longer tax-free, furnished holiday lets lose tax benefits, and that's just the start, even before we get to global uncertainty and tariffs. So after that very cheerful intro, what's top of our agenda today?
Well, Ellie, and indeed listeners, you'll be pleased to hear I've chosen not to talk about tariffs today. First up, I wanted to talk about an ultimately fruitless appeal by JD Wetherspoon to reclaim £5 million in VAT on the basis that cider is not an alcoholic beverage.
I caught the sneaky pun there, John. We do love an absurd VAT story here at the Tax Factor, so tell us what's been going on.
Thanks, Ellie. I'm sure many are familiar with the Wetherspoon pub chain, who took a generous view of emergency legislation passed during the pandemic, which gave a very specific VAT reduction to the hospitality and catering sector. During the pandemic, the VAT rates were reduced to 5% before latterly being increased to 12.5%, although this did not include alcoholic drinks. However, the legislation itself did not mention cider, and so in May 2022, Wetherspoons submitted a £4.95 million VAT refund claim on supplies of cider made between July 2020 and March 2022. That initial refund claim was promptly rejected by HMRC. A review was requested shortly thereafter, with HMRC again upholding its decision. Wetherspoons then lodged an official appeal to the first-tier tribunal in October 2022. Unsurprisingly, HMRC heavily contended this, with HMRC's barrister noting it would be anomalous and absurd for cider to be treated as falling outside the definition of alcoholic beverage, given that every other alcoholic beverage, spirits, beer, wine, and made wine, clearly falls within that definition, and particularly given the similarities between cider and made wine in the form of fruit ciders, Kelsa Breeze. In their arguments, Wetherspoons barristers cited parliamentary debate from as far back as 1932, as well as Finance Act 1972, where cider was indeed classified as a soft drink. However, it was noted that when purchase tax was introduced in 1976, cider was thereafter subject to excise duty. The tribunal acknowledged that cider was historically treated differently than spirits, beer, and made wine, but that it had been subject to both excise duty and VAT for around 50 years, and so noted that there is no reason to think that the House of Commons would have wished to exclude cider from the definition of alcoholic beverage, to which the reduced rate did not apply. The tribunal concluded that cider did fall under the definition of an alcoholic beverage, thus rejecting Wetherspoons' VAT refund claim. The appeal was dismissed, but Wetherspoons has the right to appeal again. Watch this space.
Thanks, John. That is absolutely bizarre and not one that I thought I would see. And I didn't actually know that cider had been classified as a soft drink all that time ago. But yeah, it'd be interesting to see what Wetherspoons do, because I'm sure they don't want to be missing out on millions of tax relief. But on to R&D, my favourite subject, of course. So the founder of Mojo, which is a men's sexual health and wellbeing app, has recently warned that HMRC's aggressive crackdown on research and development tax credits risk punishing genuine innovators. So his company has been going back and forth with HMRC for over a year now, and the amount that they'll have to pay back is over £400,000. So not an insubstantial amount of money. For some context, the app they've built has actually attracted more than £5 million in venture capital funding and has thousands of users in 150 countries. So it's a serious business. And there's obviously other businesses out there that have recognised that they should be investing. So the founder said that he dreads those brown envelopes that have been plaguing him for the last year. I think we all kind of dread those brown envelopes when they come through the door. As with many anecdotes from those who've been through similar experiences, HMRC have frequently been asking the same questions for the information that they've already been supplied, but also they keep being asked to produce timesheets. And there are kind of two issues. Firstly, the company doesn't even keep timesheets, so there is nothing to provide, which apparently at this stage HMRC haven't accepted. But also, secondly, there isn't any statutory requirement to have timesheets as part of the calculation, so they're in a very difficult position. But actually, this isn't uncommon if you've been following what's been happening with the inquiries over the last 5 years. Of course, this is incredibly stressful for this business, and they have been looking at different routes of arbitration. But I guess the key thing is actually the other point that the founder makes, that genuine claimants are being put off from claiming because they're worried that they won't get the relief, or they're worried that actually they will put that claim in and subsequently they'll have to pay, the full amount back, plus maybe a penalty, plus definitely interest. And that could be up to 15 months later. So knowing that that's hanging over their heads is really putting them off. I really think that we should be moving towards a sort of a check now, pay later, rather than the pay now, check later, because I think businesses would be much happier if they received the payments, for example, 6 months later rather than 40 days later, knowing that actually that claim has been checked and approved, rather than, as I said, up to 15 months with that hanging over their heads, that brown envelope might pop through the door, and then you could be fighting that for a long time. But one positive thing that HMRC have done is, for those that were listening to me back on one of the many podcasts that I've done for the Tax Factor, there was a claim notification form that came into effect for periods beginning on or after the 1st of April 2023. So it was the 31st of March 2024 year ends that we really saw the need for that to happen. Now, HMRC had put out some guidance between September and October of 2024 that was incorrect. And by incorrect, I mean it was misleading in that it didn't match the legislation, and it gave the impression that some of those businesses did not have to file the claim notification form. There has been a lot of uproar since then, and HMRC have conceded that now, if the other conditions that misleading guidance was met, you can potentially put forward a claim. So there is the recourse now, which is great for some of those businesses who perhaps were thinking that they were going to be out of pocket for an entire year's worth of claim.
Fascinating, Ellie. Thank you. And I'm really glad I'm not an R&D advisor. And I'm really
it's a wild ride at the minute.
I'm really glad that we've got someone like you in the business to help. Thank you. Moving us on, news of a new tax. We know there's many taxes in the UK tax system, but a new tax. Liverpool has become the latest city to charge visitors an overnight tax, with £2 per night fee to kick in from June of this year. Now, at present, neither central government nor local authorities actually have the legislative power to introduce a tourist tax. However, following Manchester's lead, Liverpool City Council have introduced a form of tourism levy via a legal workaround. In practice, the tax raised will be controlled by the City Accommodation Business Improvement District. What, you may ask, is a business improvement district? Well, it's a partnership operated by local business which are intended to provide services or improvements to a particular specified area. Business improvement districts are funded in large part by an additional levy on the non-domestic rate bills paid by those businesses. The levy is collected alongside their business rate payments. But this new tax is in addition to that levy. Of the 83 hotels in Liverpool balloted about the visitor tax, 59% were in favour, on a relatively low turnout of 53%, so not really an overwhelming majority. Nonetheless, Liverpool's £2 visitor tax is projected to raise around £9.2 million over 2 years, which will be reinvested in the local area and replicate schemes which are widely used across Europe.
Well, I was about to say, I mean, that's such an interesting thing that people are looking at. And I think sometimes people forget we are a tiny island. And actually, if you go to, as you said, other places across Europe, if you go to Europe, Italy, but even if you go further afield, so if you go really anywhere in America or the Caribbean, often it will say, per night we have this fee, and it's a tourism fee, or sometimes it's called a tourism tax, or, however they want to call it. But actually, they're pretty high. I think £2 a night isn't too bad. Sometimes if you I'm guilty for scrolling on Booking quite a lot, and you see some of them and you think, oh God, well, I'm not going to go there because they have a $50 per night per person tax, and that can really rack up. So that's interesting. But now, not a new tax, but revisions are being considered to the soft drinks industry levy. So fear not, this is viewed more as a health initiative rather than a tax-raising measure, but ultimately it would likely result in sugar tax on milkshakes and things like your morning lattes, as they're looking towards the different, the sugar content of milk. So published on Monday this week, the government are consulting on proposals for changes to the minimum sugar content threshold at which the levy applies, and the current exemptions for milk-based drinks and milk substitute drinks. So if you're walking around the supermarket, you'll likely see that they are absolutely stacked with low sugar fizzy drinks, many just below the 5 gram grams sugar per 100 millilitre threshold. But the government has said, and I quote, it's time to set a more ambitious target. So the proposal is that they want to reduce the threshold to 4 grams as opposed to 5 grams. For milk-based drinks, the proposal is to remove the exemption and introduce a lactose allowance. So that will account for the natural sugars in the milk component of those kinds of drinks. And for milk substitute drinks, the exemption will be removed for those with added sugars beyond those derived from the principal ingredients, for example, oats or rice. The consultation closed on the 21st of July with final plans to be confirmed by the Chancellor at the budget this autumn. This was just one of a number of proposals made earlier this week, John. I think there were some other ones.
That's right, Ellie. The government has certainly been very busy this week as a major announcement on Monday by James Murray, the Exchequer Secretary to the Treasury, delivered commitments made at Autumn Budget 2024 and Spring Statement 2025, aimed at simplifying the tax and customs system to help deliver the plan for change. The package of technical tax policy proposals are intended to support the government's stated ambitions to simplify and modernise the tax system, tackle non-compliance, make the tax system fairer for taxpayers, hear hear, and make the customs system work better for traders. With 39 reform measures in total, no fewer than 26 focused on simplification, 2 further administrative measures designed to strengthen the integrity of the tax and customs system, and a further 11 measures to reform the tax system, ensuring that it, according to Mr. Murray, continues to be fit for the modern world. Mr. Murray's statement noted the measures included new plans to, and I quote, reduce bureaucracy and increase efficiency at HMRC, to deliver the government's ambition to become a more productive, agile, and effective state. Some of the many notable measures include delaying the mandating of payrolling of benefits in kind from April 2026 to April 2027 to reduce the burden on businesses, an intention to raise the income tax self-assessment reporting threshold for trading income and align it with the new ITSA reporting thresholds for property and other taxable income at £3,000 gross each. It is expected that this will remove the requirement for up to 300,000 taxpayers to file a self-assessment tax return, with the changes promised to be implemented within this Parliament. As recommended by tax professionals, yes, that's us, HMRC will simplify guidance on self-assessment registration obligations to ensure clarity on when individuals must register for self-assessment. Additionally, reducing paper post sent, saving £50 million a year by 2028-29 by investing in digital services to send and receive taxpayer information, improving value for money in the system of tax administration by reducing the HMRC estate in central London by 25%, with a commitment to have 85% of HMRC staff based outside London by 2030. And finally, scrapping the Valuation Office Agency, which is responsible for valuing properties for council tax and business rates, and moving all of those functions within HMRC, which is expected to deliver between 5 and 10% savings in administrative costs by, again, 2028-29.
That is a lot of new proposals, John. Let's hope some of those come to fruition. I'm particularly interested in the ones around simplification. As anybody who listens to the podcast or works in tax will know, we have one of the most complex and layered tax systems in the world. So any simplification is always welcomed. It was really interesting also about the reducing the paper post sent. HMRC seem to be completely obsessed with sending things by post, even when you've told them that you can communicate by email, that you understand the risks. So I think people absolutely love that, especially given that they only ever seem to use second-class posts. By the time you actually get the letter, you only have about 1 hour to respond.
Yeah, lots of welcome change.
The Tax Factor from Blick Rothenberg.
That's about it for this episode of The Tax Factor. I think it's time we retired to the pub for a well-earned, refreshing glass of cider and a reflective sigh over the futility of that Wetherspoons case.
Honestly, what a saga. But before we go, a quick heads up for next week. Nimesh will be in the hot seat, joined by our pensions expert, Martin Reynard. His insight and pensions wisdom are always a great listen.
Trust us, if you've got a pension or just wish you had one, you'll want to tune in.
But that's it from us for now. Thanks for listening, and if you're in the UK, enjoy the long weekend.
Goodbye.
Goodbye.
That's The Tax Factor. If you enjoyed The Tax Factor, please like, share and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.